Welcome students. In today's lecture session, we will discuss another important topic related to working capital management, that is cash conversion cycle. We will discuss its concept, how it is different from operating cycle, and what are the main components of cash conversion cycle. We will also discuss the calculation part of cash conversion cycle with suitable examples. So for easy and simple lecture sessions, do subscribe to my channel Kanwal Sidhu. As we know that working capital helps the company to meet its short-term needs like purchase of raw materials, payment of wages, and other day-to-day expenses. And the investments made in working capitals are also less risky as it is just for a shorter term. So we can say that working capital management represents the relation between firm's short-term assets and its short-term liabilities. And the goal of working capital management is to ensure that a company can manage its day-to-day operating expenses. It enables the companies to maintain sufficient cash flows to meet its short-term operating costs and short-term debt obligations. Then it also ensures that a company operates effectively by monitoring and using its current assets and liabilities to their best level. And mathematically, it can be represented as current assets minus current liabilities. The current assets includes the cash and accounts receivables, and current liabilities includes accounts payable. So we can say that working capital management plays an important role in the smooth functioning of the business organization. These are the four main components of working capital. First is accounts receivable. These are what the customers and the debtors owe to a company for past sales. Every company should collect its receivables in a timely manner so that it can meet its operational cost. Accounts receivable appear as assets on a company's balance sheet. Second component is accounts payable. That is the amount that a company must pay out over the short term. It includes supplier invoices, unpaid dividends, operational costs, and upcoming tax payments. The debt payments towards loans and other borrowed funds are also part of accounts payable. Then is the cash and cash equivalents, which are also an important component of working capital. And managing of these liquid assets effectively is important for proper management of working capital. The fourth important component is the inventory, which is firm's primary asset that is converted into sales revenue. The rate at which the company sells and replenish its inventory is a measure of company's successful working capital management. The inventory levels should neither be low nor be too high. So we can say that managing of these four components of working capital is important for working capital management. The cash conversion cycle tells how much time it takes a firm to convert its investments in inventory to cash. Or we can say it is the time the company takes to turn its inputs into cash. This definition is clearly explainable by this figure, and mathematically we can represent cash conversion cycle as DIS plus DSO minus DPO. Here DIS is days inventory outstanding, DSO is days sales outstanding, and DPO is days payable outstanding. We will discuss these in detail. The cash conversion cycle has three main components. The first is days inventory outstanding, which is average time to convert inventory into goods and sell them. Or we can say days inventory outstanding is average number of days that a company holds its inventory before selling it. So mathematically it is represented by this formula. For example, the beginning inventory of KSS company is rupees 1000 and rupees 3000 is ending inventory for a fiscal year 2021. The cost of goods sold is rupees 40,000. So the days of inventory outstanding is calculated by putting these values in the above formula, and we get the result 18.25. So the KSS company takes approximately 18 days to convert its inventory into sales. So this is days inventory outstanding. The second component is days sale outstanding, is average amount of time in days it takes the company to collect its receivables or collect payments after sales. The formula of days sales outstanding is given here, that is average accounts receivable divided by the total credit sales into 1 year, that is 365 days. So for example, we take a same example, that is KSS company has rupees 4,000 in the beginning accounts receivable and rupees 6,000 in the ending accounts receivable for the fiscal year that ended in 2021. The credit sale is 1,20,000. So the days sales outstanding of KSS company is calculated by this formula, and we get the result, that is 15.2. So the company, that is KSS, takes approximately 15 days to collect payment after sales. So this is days sales outstanding component. The third and the last component is days payable outstanding. That is number of days on average it takes a company to pay back its payables, or the average number of days for a company to pay its invoices from the suppliers. The formula of calculating this days payable outstanding is shown here. So let's take an example that KSS company has posted rupees 1,000 in the beginning accounts payable and rupees 2,000 in the ending accounts payable for the fiscal year that ended in 2021. The cost of goods sold is rupees 40,000. So by putting these values in the given formula, we found that KSS company takes approximately 13 days to pay its invoices. So this is how we calculate the days payable outstanding. So far we have calculated the values of three components of cash conversion cycle, that is DIO, DSO and DPO. Now we put these values in this formula. By calculating, we found that the KSS company takes approximately 20 days to convert its initial investments in inventory and back into cash. So we conclude that shorter the cash conversion cycle, the better the company is at selling its inventories and receiving cash from these sales while paying the suppliers. We can conclude that cash conversion cycle is important for the company as it helps the company in managing the working capital. It also plays an important role in inventory management. The calculation of cash conversion cycle helps financial manager to assess the company's financial health. Then cash conversion cycle also can be used as a key performance indicator for the management in order to expand its business operations. Finally, we can say that the cash conversion cycle plays an important role, especially in financial decision making, as it depicts the overall financial picture of the company. Before ending this lecture session, let's discuss how operating cycle is different from cash conversion cycle. As we know that cash conversion cycle measures the number of days between your date of payment for the goods and the date of receiving the cash from the customers. In simple words, it is the time between the cash going from the business and cash being received by the business. On the other hand, the operating cycle measures the number of days between your date of buying the inventory and the date your customer pays for the goods. A shorter operating cycle can lead to shorter cash conversion cycle. These both are equally important for the organization. So both should be properly analyzed individually as well as jointly. So I hope now this difference between cash conversion cycle and operating cycle is clear. So this was all in today's lecture session. Thank you.